Good morning, everyone. Thank you all for taking the time to attend our webinar series today. We are focusing on executive benefits. My name is Ron Linneman. I'm a benefits consultant for WA Group. We have Corey Anderson here as well, who I'll introduce in a second. But before we begin, I wanted to address a couple housekeeping items. We'd like to keep our webinar series to 40 to 45 minutes in respect of everyone's time and really concentrate on the content. So with that, there will not be any question and answer at the end. So please use the Q&A at the bottom to type in your questions. Following the webinar, we will capture all of your questions and create a FAQ with answers to your questions that will be sent out via email and then also posted on our website, which is listed there at the bottom, walivebig.com. You can also view past webinars, the video as well as the FAQs on our website, and then learn about upcoming webinars that we have as well. Another way to connect, get your questions answered, is to connect with one of our team. As I mentioned, my name's Ron Linneman. Other members of our team are listed there along with their contact information. And so if you do have any other further questions and we're not able to post your question in the Q&A, please connect with one of our team members. This slide will also be listed at the very end of the presentation in case you need to jot that information down. I want to start just by listing out who we are. WA Group is a consulting firm. We are a local 100% employee-owned risk management firm. Our job is to identify risks within your organization, business and people related risks, and help create strategies to help employers address those risks. The way we do it is through our VAST process. It starts with understanding your goals, where you're trying to take your company, your risk tolerance. Once we have an understanding of your vision, then we perform an assessment to identify those areas of risk. Once we are able to identify those areas, we then create a strategy to address those risks. And none of it is successful unless your team and our team work together to accomplish that goal. The area of risk we're addressing today is really on the executive side of things. So the problem is, when employees lose their job because they become disabled, or they lose their job, they become disabled, and now their retirement plan is not being funded. From an employer side of things, you lose a key person. How does that impact your business? You yourself as the employer are not able to come back to your own business because of a disability. How does that affect your family? How does that affect your employees? How does that affect your business? What are ways or what are different strategies you can put in place to address those problems? This stress and anxiety of dealing with an illness. So not necessarily just the financial aspect of it, but now you have a completely different problem altogether, and it completely changes the vision and the future of your organization. So really today is addressing that one area of risk within your business, and that's where Corey Anderson comes into place. Corey Anderson specializes in executive benefits. He's been doing it for a little bit. A few years he's been in the business, and with that comes a number of different awards, speaking engagements. Being the industry expert allows him to help out a number of employers locally, around the country, and we are appreciative of his time to come here and talk to all of you about this area of your business, and hopefully you're able to take something away with that. So with that, Corey Anderson.
Ron, appreciate you having me. WA Agency, appreciate it. Let's get right into the presentation and going through it. And like we said, to answer questions or put your Q&As at the bottom, and somebody will follow up with your answers. So business planning, business owners' top priority for financial planning. So they list as their number one priority, yet only 46% of them have plans to help safeguard the business if unexpected events like disability to a key person or business owner occur. So they say it's their number one priority, but yet not many of them have it. Income protection, they list this as their number 3 priority, yet only 42% have individual disability coverage out of the businesses that we see out there in the marketplace. We go to the next slide. Our goal is to build a solid foundation. And with a solid foundation, what we do is we look at the bottom as disability insurance, making sure we have the correct coverage, not part of the coverage. What we put above that on the financial pyramid is we've got your auto owners or auto insurance, you have your life insurance, you have your health insurance, you have your property insurance, and then kind of up from there, you move into your retirement plans, personal investments, things along those lines. And eventually you move on to maybe some assets that you want to pass on to your next generation. But at the bottom, the beginning of the financial pyramid is disability insurance, which protects your living. If we go on to the next slide, understanding the value of your income. Income provides for the big and little things in life. So Ron, we want to cover our home, we want to cover our car, we want to cover our groceries, cell phone. Heck, a lot of people have cell phone insurance and they protect their cell phone better than they protect their personal income. So we'll get into a little bit of what does that look like. Ron?
Yeah, Corey, you one of the things I wanted you to talk about is what are some of the myths or maybe excuses you often hear from key players when discussing the importance of protecting the contribution they bring to their companies?
Disabilities happen to other people, not to me. It's amazing how many people tell me they could do their job from their wheelchair, and I'm like, let's rent a wheelchair and let's put you in the wheelchair for a week and see how productive you are. People don't think it can happen to them. However, their odds are very high, which we're going to get into as a poll question here in a little bit. My business can run without me. And so I ask the key person or the owner, I say, so when was the last time you took a vacation for 3 months? And the answer is never. What about even a month? And usually it's never. What's the longest vacation you've taken? Well, in the last 5 years, I took 1 2-week vacation. So what I'm hearing out of that is that a 2-week vacation is the longest you've ever done, and they only did it once in the last 5 years. So can your business really run without you and be as productive as it is without you there? The other thing is I'd rather put my money into growing my business, which I get that. I've owned my own business for 17 years. However, at the same time is your big financial risk is tied to you showing up to work every day, not being sick or hurt, and not dying. And your asset is growing that business, but let's make sure if something happens in the short term or in the next few years or the next 15 years, that your dreams still happen for you, still happen for your family, your kids, all of that stuff. So what is the likelihood of disability? For one owner, if you have a one owner business, 24% chance that that the owner will become sick or hurt and unable to work for 90 days or longer prior to age 65. However, what if you have a 3-owner business? What's the chances that you're going to have one of the owners, something happen to one of them before age 65 and be out sick or being sick or hurt for 90 days or longer? It's a 57% chance if all 3 owners were 27. If all 3 owners are 47, you got 43% chance one of them is going to be disabled, sick or hurt for 90 days or longer. So the likelihood is a lot higher than people really think about. And one thing on disability that I think of is a lot of people maybe have heard of some people being disabled, but they maybe have not seen it personally, or they forget about it. People who become sick or hurt kind of almost disappear. They're maybe not showing up. They're not showing up at the office. They're not showing up at social functions. They're not showing up at church or whatever it may be. And so they kind of end up disappearing, and people forget about these people, but they're sick or hurt and not showing up to work. So the likelihood is very high. So some solutions to meet your needs. One is to pay everyday living expenses and maintain your lifestyle. You want to continue to save for retirement. You want to provide a well-rounded benefits package. You want to pay business expenses like rent and salaries and stuff like that. And then 5 is you want to have the transition of the business to another owner. So we're going to go through some of these types of events and making sure that you cover all of the events, not just some of the events. So 68% of HR professionals say they have difficulty recruiting candidates for full-time positions. The Society of Human Resource Management estimated that companies spend an average of 42 days to fill a position and $4,129 per hire if they do the hiring themselves. So it's a little over $4,000 if you do it yourself. And I wonder if that $4,000 includes all of the expenses, like the time that each person's sitting in meetings, going through interviews, going through resume, stuff like that. If a company uses a recruiter, they can expect it to pay around 25% of the new hire's annual compensation. Then there's the training. To come up with the cost of structured training, you have to take into consideration the cost of managers, key coworkers, and the new employee from the initial hire date to the point of 100% productivity. Then you have the cost of equipment rises each year. New computer, phone, cell phone, printer, all adds up. So the goal of investing in a new employee is almost always to maintain or increase productivity, right? But it's estimated a mid-level employee requires 6.2 months to reach their break-even point, meaning it takes more than 6 months for the company to earn back its investment on that hire. The bottom line is, when employees find a sweet deal elsewhere, it costs employers a lot of time and a lot of money to invest in a new employee if they lose that employee. So attracting and retaining great employees. Employees and candidates are looking at factors beyond salary. A strong benefit package plays a key role in hiring and retaining employees. 45%, if you can go to the next slide. 45% of working households in the United States have no retirement assets. Think about that, 45%. So are you one incident away from losing your business? We all could run into financial trouble at any point in our lives. Those of us who haven't planned for a life-changing event could see our savings and retirement wiped out. Only 18% of Americans say they are saving enough for retirement. 44% of adults say they couldn't cover a $400 emergency expense without selling something or borrowing money. To me, that blows my mind, but it is what it is. So with that all said, Ron, you want to take over? Sorry.
It would help if I went off mute. Comes to our first poll question. What keeps you up at night? What is the statistic that you can't fall asleep, thinking about?
Well, I've got one, but I'd like to hear from our attendees first on it. So we have a poll question. How many of today's 20-year-olds will become disabled before they retire?
Hang on there 1 second, guys. I apologize. I'm getting an error message here. Give me 1 second.
No problem.
So you guys can think, ladies and gentlemen, can think about it here while we're bringing it up. How many of today's 20-year-olds will become disabled before they reach retirement age? 1 in 4, 1 in 10, 1 in 12, 1 in 18 or greater. We'll give it here just another, we got 20. What do we got?
Just about 60%, a little over 60%. Give it 5 more seconds, 2 and 1. And the polling.
So 59% of you thought 1 in 4, which we kind of gave the answer away earlier if you're listening. 1 in 4 is the answer. 1 in 4 of today's 20-year-olds entering the workforce will become sick or hurt 90 days or longer before they reach retirement age. That's the answer. So when you think about employee benefits, health insurance, paid time off probably spring to mind, right? But what about disability coverage? It's easy to forget this piece of your benefits plan, but it should be a key area of every employed person's financial plan. So with disability insurance, when we look at the disability insurance, you have your kind of basic needs, your income protection, individual disability income, we can cover that with. We can cover it with a multi-life disability policy or an employer group plan. So what are we talking about? A lot of you on this call might already have a group disability policy at work, but with group disability, it's only covering a certain percentage of your wage. We can go above that number and get us to a lot higher percentage replacement of income. So we can do that in a multi-life environment where we can come in and do it just like a group plan, where we don't have to answer a bunch of medical questions if we do a large enough group. If it's a couple of individuals, it'll look a little bit different. Retirement savings, you have your DI retirement protection, so we can protect your retirement savings. What people do when they're sick or hurt is they're spending every dollar that comes in, and then when they get to retirement age, they have nothing to retire on. So this is a policy kind of like a 401k replacement if you're sick or hurt. Business protection, we have business overhead expense, business loan, key person. We'll get into some of that. And then exit planning, disability buyout, disability buy-sell. So individual disability insurance, what does it look like? If we go to the next slide after, with this is the objective of disability insurance is more or less to replace all of your income. And what you'll see on the right-hand side in the chart is you have 60% of your group, but your group doesn't cover anything, meaning it doesn't cover anything outside your wage. So typically it might not cover bonuses and commissions unless you set it up that way. It might not cover K1 earnings if you're a business owner, depending on how you set it up. But also then is it's not covering your retirement contributions that are potentially done through the business or like a 401k match of key people. Also, it's not going to be covering the health insurance premiums. If you become sick or hurt, you'd have to pick up COBRA eventually if you're not the owner. It doesn't cover those. It doesn't cover your cell phone reimbursements, your car reimbursements, stuff like that. So we have group disability, then we can add individual disability insurance. Typically, it's about 25% replacement on top of the 60%. And then we can add a catastrophic feature. So if you have that quote unquote Christopher Reeves type disability, it'll provide an additional 15%. And then on top of that, we can even go to 115% replacement by adding retirement protection. When people are sick or hurt, I've never had a client return a claims check and say it's too much money. They always say, darn it, I wish it was more. I wish I would have purchased a higher benefit amount. So Ron, if you want to insert, we're going to insert this poll question. What percentage of income is the typical cost to protect it? What percentage of income is the typical cost to protect it? If you could just cast your vote and we'll have the results here in 5 seconds.
Yep. 3, 2, and 1.
So 1 to 3% is what 44% of you said. What I find interesting was the last one where 38% said greater than 10% is the cost to protect your income. In reality, the answer is typically 1 to 3%. And everybody always asks me, how much is it going to cost? Well, it's just like buying a car. You can go buy, I went to school at St. Mary's University. And when I was down there, I had a $100 car. It was a 1984 Fairmont station wagon, completely rusty. Anyways, it was a $100 car. But you can also buy a car for $1 million. It's all over the board, just like disability insurance. It depends on, do you want the Cadillac Escalade or more of the Ford Chevy? Depends on what you want. So typically it's 1 to 3%. I even say usually more towards the 1 to 2% or less. It just depends on how you structure the plan that you go with. So disability retirement protection, what is that? Let's get into a little bit on the details of it. Disability retirement protection, the objective is to continue saving for retirement. However, continue saving for retirement in the event of a disability. The benefit is upon qualifying for a disability, benefits are paid to a trust to be accessed as retirement income. So the trust you can't access till you're 59 and a half, just like a 401k. So if you're sick or hurt, it pays the money into the trust. And then once you reach 59 and a half, you can take it out for your retirement.
So assuming, Corey, that I have income protection in place, the money I have already saved for retirement is still going to be available to me at the age of retirement, correct? So why would I need retirement protection?
Well, Ron, you probably work 40 plus hours a week. And when you're working 40 plus hours a week, you're probably not sitting on Amazon, right? And you're probably not taking a vacation at that time because you're at work, right? If you become sick or hurt, you're still going to want to take the spouse out to dinner. You're still going to want to go to the movies. You're still going to want to go on vacation. And you now have Amazon at your fingertips 40 more hours a week. And if you're sick or hurt, your medical expenses just skyrocketed. So what ends up happening is people stop funding their retirement once they become sick or hurt. And so whatever they have saved up, they'll have available for retirement, but they aren't adding to it. And a lot of times that's when you're getting to the age where you would have added a lot to your retirement savings and you're now no longer able to add to it because you're sick or hurt and you're spending every dollar that comes in. Typically, it's going to be 9 times out of 10, people are going to spend more money at claim time than when they're working. So we had a run. So how retirement protection works. We have the insured, we have the carrier, and the irrevocable trust. Just a quick overview is you pay the premiums to the carrier. If you become sick or hurt, they're going to pay to this irrevocable trust. You can't access the money. You can invest it, though. There are investment options in it. And then during retirement, it'll start paying out from that. You can go to the next slide. So business overhead expense insurance. What is this? So when we get into business overhead expense insurance, the objective is to reimburse your business for expenses if you're too sick or hurt to work. So benefits helps ensure a business can remain open and the owner can either return to a financially sound business or sell a business that has not depreciated because of the owner's disability.
Corey, out of curiosity, what sort of business expenses are covered?
Well, it's amazing, Ron. It's like I read your mind. Some sample covered overhead expenses are accounting, billing, collection fees, employees, salaries and benefits, and there's a whole list there. The main ones that I cover is right away, we want to try and cover any rent payments and utility payments and employee expenses. Those are the big 3. We can even cover a replacement for you. So if you need to hire a replacement for you, we can cover that as overhead expenses. The nice thing about business overhead, I'll say one other thing on it, is tax deductible to the business. So the business gets deducted as a business expense. At claim time, they reimburse you for those covered overhead expenses. You do have to report it as revenue at claim time, but it's used to pay business expenses. So it's in essence a wash at claim time. So let's get into business loan protection insurance. What is this? So business loan protection, the whole goal is to reimburse the owner for covered overhead expenses. So, or I'm sorry, not reimburse, I apologize. Reimburse the owner for covered business loan stuff. So in essence, if you go set up a loan with a bank and you take out $1 million line of, well, not a line of credit, you do a loan, like a 10-year term or a 7-year term, what we can do is we can set up a plan that if you as the owner become sick or hurt, that loan payment is covered every single month if you're sick or hurt. So it's a decreasing term policy, but it covers that loan. And a lot of times if you're working with your bank, you can a lot of times get a lower rate by covering that on the business loan side. So the whole point of it is to keep the doors open if something happens to you and make sure that loan gets paid. Key person insurance. So what is some key person insurance? Key person protection is the whole point is to reimburse the owner for covered business related loan obligations during a disability. So the key person, we're covering that key person, and it's helping the business if something happens to that key person. It's also, think of it as a lot of times at claim time, if we have some key person go down, the business is going to suffer. You might have that rock star salesperson that's maybe revenue 60% of your business. Well, if something happens to that person, are you going to find somebody to come in and create that amount of revenue right away? So what it does is if the key person, something happens to that key person, we could end up having that policy pay out and cover that person, more or less that revenue to the business if that person becomes sick or hurt, or you can also do it on the life side. Disability buy-sell insurance. So what is disability buy-sell? The objective is it funds a buy-sell agreement, helps with the buyout of a disabled owner's interest in the business in the event of a long-term disability. With buy-sell insurance, a lot of people think you need two people. They think you need to have at least two owners. That is not the case. You can do a one-person buy-sell, and we have products available for disability on that. And the reason I think of that is if I'm a business owner and I'm a one-man show or one-woman show and I've got employees and something happens to me, does the value of my business drastically drop immediately? And I believe the answer in most scenarios is yes. People smell blood in the water. The sharks see blood in the water and they say, you know what? Person's sick or hurt, business is going down. We can buy it for pennies on the dollar. Whereas this is you can have a one-person buy-sell and in essence make sure you guarantee the value of your business if you become sick or hurt. So let's hop into the other wonderful topic of life insurance and how this relates into the business. So a study found that 43% of all employees would feel a financial impact within 6 months of a primary wage earner's death. So in essence, most people, if they lose that family member or person in the business or whatever it may be, 6 months in, you're big financial impact. So what are some options? Key person life insurance. With key person life insurance, what we can do is a lot of people refer to this as golden handcuffs. This is where it gets interesting. There's a lot of options within this, but the objective is a key person life insurance plan can help business owners attract, retain, and reward high-performing employees. It features a valuable death benefit that can be used by the employers to recover plan costs or to provide for survivors' benefit. So it's expanding into a new marketplace and you're having, let's say you're expanding a new marketplace and you're having to hire new talent. Well, that new talent might cost you quite a bit of money, and investing in that new area that you want to get into, you want to make sure that you're going to recoup the cost if something happens to that individual. So you could put the key person disability that we talked about. We could also put on a key person life insurance where if that person dies, the business receives a death benefit. Now we can structure this where the key employee gets his family or her family gets money, but also that the business does. So one example I'm going to kind of share on this is we had a business where it was a really growing business, but it was small. At the time, it was about 5 or 6 employees, and they had one individual that they didn't want to give ownership to, but they wanted to make sure that employee was going to stick around because they were key to the future of the business. So what they did is they said, let's put in a split dollar arrangement where more or less golden handcuffs, where we're going to fund their retirement at a significant number. And if they stay for 15 years, they will receive this money. And during that process, if they die, the company will receive a large portion of the death benefit and the family will receive a smaller portion of the death benefit. And that number will start to reverse where eventually the employee's family will have more ownership in it from the standpoint of the death benefit until we reach that 15-year period or whatever mark we set at. So the most recent one we did was 15 years, and we set it as 15 years. And if that employee sticks around 15 years, they get a large lump sum of cash through the life insurance policy for their retirement. So there's a lot of options within that, but the whole thing of it is to retain and reward phenomenal employees. The business owns it and they get the money if something happens, but also the employee does get some money as well. So how key person works, we'll dive into it a little bit more here, but with it is the employer contribute some assets, the premium, they're contributing to it into a deferred comp plan. And then the deferred comp plan is we're going to end up purchasing a plan, a life insurance policy. So we have an asset tied to it. And eventually the benefit will get to the employee. So the employer's purchasing the policy, the premium payments. It depends on how we set it up. There's many different ways on setting this up. You can do $500 a month to, for example, one we recently did was $2,500 a month. The employer contributed towards that plan. So the policy, you can set it up many different ways, but the beauty of it is you can customize it for your business to take care of a key employee and take care of the business should something happen to that key employee.
Corey, can you touch on how the benefit is paid upon the insured's death?
Yeah, there was one slide in between, and I'm going to touch on, and then I'll touch on it. But you have a loan protection life policy, so you can do that. There, it covers it a little bit on this slide. If you go to the next slide, then too.
Yep.
But to answer the question directly is, sorry, I apologize. I lost my spot here. Hold on one sec. So on the insured's death, what it's really going to be is it's going to be a percentage to the business, and they're going to recoup that cost that they paid for that they invested in that and more. And then the individual is going to recover some of the death benefit depending on how you set up the percentages. So it just depends on more or less how you set that up. So buy sell, the whole buy sell life policy. So the buy sell life policy provides the cash to buy out the deceased partner's estate. Typically options are term. You can do universal life, you can do variable universal life, and you can do whole life. Term insurance, keep in mind, term insurance is very low in premium. Why? Because less than 2% of all policies ever pay a death benefit in term, because most people live past the term. What we do if we're doing something where we're rewarding a key employee, that's where we'll use a permanent policy. The permanent policy you'll use is a universal life or a guaranteed universal life or variable or whole life. There's different options with that. There's pluses and minuses to each of those questions. But the whole point of it is the clean transfer of ownership at time of death.
So with that, we have our last poll question of the presentation. When was the last time you conducted a business valuation? We'll give everyone about 30 seconds to chime in. Got just about half of everyone in. Give it 5 more seconds. 4, 3, 2, and 1.
So poll results. Find it interesting that 44% had said I haven't ever done that. And then we had some that had done it within the last year, et cetera. But it looked like the biggest one was I haven't ever done it. 44% have said I've never done one. What we're offering here is we want to talk about a business valuation is it can help shed light on the potential business protection opportunities and should be conducted every 3 years or less. What you can do is you can contact your trusted WA Group advisor to learn more. There is a program available to do business valuations and also buy-sell reviews as far as your buy-sell documents. A lot of times people set up a buy-sell agreement when they first start a business with one or more individuals, 2 or more owners. And the thing with that is they create the document, they set it in the file cabinet or wherever it may be, or electronically stored these days, and they don't look at it. And 10 years later, what do you know? That business that was barely getting by is now worth millions of dollars. They haven't looked at it. That agreement should be looked at least every 3 years, if not more often, both on the valuation side of it and also getting into the actual agreement document. My understanding, correct me if I'm wrong, can I chat about or say something about that process a little bit more?
Please.
That process, my understanding is WA Group, we have a relationship where we can have free reviews from a very trusted insurance company, a very large company, where they will review the buy-sell documents and provide input. They'll review the buy-sell valuation. They'll literally put a valuation on the company, and they'll do different parts of it. The only thing they say is since they aren't charging for it, they will not go in front of the IRS to defend it. But they do this for companies all over the United States, and they do a ton of these. They've got multiple attorneys on staff putting these together and accountants. So it's a phenomenal process. We've done this for many clients, and it's a wonderful process for you to just see what's my business worth, what are my buy-sell agreement, is there some problems with it, and they'll provide you some different stuff, and then you can go back with your accountant or attorney or both and put the right stuff together.
Good. Thank you, Corey.
You're welcome.
It's amazing to me, you know, we're meeting with a few hundred employers on an annual basis, and these are questions that we're bringing up every year at renewal time, and it's fairly shocking as to how many employers have gone the amount of time that they've gone without any sort of coverage in place. I think the call to action from this webinar for employers out there is really just to understand your risk. There are certainly ways to address that risk, and whether it's length of time of when the policies start, and even putting a policy in place altogether, really understanding what you're risking as an individual, for you personally, for your family, and for your business partners, by not at least evaluating what that risk is and then going down the path of addressing that risk. So call to action for everyone is to connect with one of our team members to schedule that assessment, to go through the process, and then, you know, how you want to address it is obviously going to be a decision you'll need to make. As a reminder, please type your questions in the Q&A down below. We'll compile your questions, put together answers, and then send out an FAQ following this webinar. Another reminder is that a recording of this webinar along with the FAQs will be available on the website. Here again is a listing of our team members. Please connect with one of us to schedule a time to go through an assessment, or if you have questions. And with that, we appreciate everyone's time. Thank you, Corey, for sharing your knowledge. And we wish everyone a great day.
Thanks, Ron. Have a great day.